This is James Nelson from Massey Knackle Realty Service speaking. I'm pleased to present to you the New York City investment sales overview for the first half of 2011. This report is made possible by our 50 agents throughout our 4 offices who cover the New York metro area. We're pleased to report that in New York City there was an uptick in sales for the first half of 2011 with a total dollar volume of $12.6 billion. This is up 52% from the second half of 2010 and up 103% from the first half of 2010. Office buildings accounted for the majority of dollar volume with 43%. This was the most sales in a half since 2007. As you can see, on an annualized basis, we're projected to have $25 billion in sales this year, which will be approaching 2005 levels, but still off the peak in 07 at $62 billion in sales. We had an overall turnover rate of 1.1%, whereas in the peak of the market in 2007, over 3% of all the properties sold that year. As far as activity by boroughs, Queens had the most improvement with a 21% increase in sales, while Northern Manhattan also showed improvement with a 13% increase. On a dollar volume, Manhattan improved the most with a 56% increase in this half, or 124% increase compared to the first half of last year. Northern Manhattan's activity decreased slightly from the second half of last year and a 50% decrease from the first half of last year. Now to look at the Manhattan market. Manhattan had a total of $11 billion in sales in the first half of this year. This accounted for almost 90% of all New York City's sales. It was up 56% from the second half of 2010 and up 124% from the first half of 2010. Again, office properties accounted for the majority of the dollar volume with 49%. In this borough, 1 to 4 families accounted for the bulk of sales with 21% of the transactions. Here, annualized turnover was higher than the city at 2%. Still off the peak in 2007 of 3.6%. As far as pricing, on an overall basis, price per square foot was up 11% in Manhattan compared to last year, or up 10.3% from 2009, when the pricing was slightly higher than 2010 due to the few transactions which took place. As far as overall pricing by asset class, walk-ups and elevated apartment buildings held at very low cap rates, ranging 5.2% for walk-ups and 4.3% for elevators. These represented price per square foot of $551 and $616 a foot, respectively. These caps moved up from their peaks in early 06 and 07. Elevators could be seen trading on average in the high 2% range, where walk-ups were in the high 3% range. However, it is important to note that the price per square foot has edged up. The explanation for this is that expenses have also grown tremendously in this period. As far as mixed-use properties, which have retail and residential or office above, the average cap is 6.28%, or $660 a foot. This cap has also increased from the peak when it was in the 5% range. Office properties traded on average at $647 per square foot. This is well off the peak where an office property traded for over $1,500 a square foot. The office condo segment of the market traded for over $1,050 per square foot on average, but this average is deceptive because several sales which took place in Chinatown created above average sales. Office condos can still be purchased in Manhattan in the $400 a foot range. Meanwhile, retail can vary greatly depending on location. It averaged $1,476 per foot. 1 to 4 families averaged $1,611 per square foot. In some cases, finished townhouses traded at over $3,000 a foot. Hotels traded on average for $420 a key, although again this can vary widely based on the quality of the hotel or if it can be converted to residential. The Carlton House recently traded for over $1 million a key, and the Hyatt on 57th Street is rumored to be in at a basis of $1.5 million a key. Development sites can also vary widely depending on location and zoning. They averaged $300 a buildable square foot, which was consistent with last. And now to look at a couple trends and specific sales. In the multifamily asset class, 200 West 72nd Street, the residential condo at the corner building on Broadway, sold for $209 million. This was over $1,060,000 per unit and a mid-4 cap, or $1,300 a square foot. The rents in this building achieved as high as $120 to $130 a square foot. Meanwhile, the Electra at 286 to 92 3rd Avenue traded for $122.5 million, or an impressive $712,000 a unit, at a sub-4 cap. In office, recaps were what dominated this asset class. 1633 Broadway was recapitalized at a basis at $980 million, or $833 a square foot, whereas 230 Park Avenue sold for an estimated $260 million, which was a recap based at $542 a square. As far as the hotel segment, On the Avenue was the most expensive trade for the second quarter at $191 million, or $715,000 a key, whereas the largest sale on gross dollars was the Radisson at 509 Lexington for $333 million, which resulted in a price per key at $468,000. In the 1 to 4 family segment, 20 East 10th Street traded for almost $19 million, which was over $3,300 a square foot for this finished townhouse. At 117 to 19 East 69th Street, this 40-foot wide neo-Grecan townhouse sold for $23 million, which was almost $1,900 a square foot. This was the highest price paid on a gross dollar amount for the second quarter. As far as retail and mixed-use properties, these values can vary greatly depending on the location. At 862 Broadway, right off Union Square, it sold for $11 million, or $21.57 per square foot, and a 6.45 cap. Geox was the retail tenant, paying well over $300 a foot on the ground floor. Meanwhile, 31 West 21st Street, a restaurant condo on a side street, sold for $2,421,000, or $605 a square foot. Development sites also vary greatly depending on location and zoning. At 356 to 66 10th Avenue, on the corner of 30th Street, the site traded for $43.5 million, or $169 a buildable foot. The majority of the site would have to be commercial, whereas a building suitable for residential conversion at 64 East 11th Street traded for over $22 million, or almost $750 a square foot. As far as the summary and outlook, again, we're going to see that volume will continue to rise, but the building count will not be as meaningful an increase, is because the bulk of the increased dollar volume activity occurred because of a rise in $100 million and above sales. We are anticipated to have a total of $25 billion in trades this year, which is still well off '07 levels, but approaching '05 levels, which is a more normalized level of activity. Value again is trending upwards with an 11% increase on a per square foot basis this half as compared to last year, and hotel sector was the most improving asset class. Again, this asset class is usually the first to be affected and the first to improve because it's not subject to any long-term leases. Land sales continue to have very strong demand, and some prime sites are achieving in the $400 to $500 buildable foot range. There's very few land and conversion properties available today. As far as potential concerns moving forward, a spike in increased rates could certainly effectuate a second wave of distress. Although we will say that most banks have disposed of the bulk of the New York City troubled assets. At this point, it'll be mostly special servicers who will be bringing distressed assets to market. We are also mindful of the political implications, as we've seen that recent changes can affect property values, as seen with the rent regulation changes, which have made it more difficult for owners to decontrol apartments. If you have questions on this report, please feel free to call me at 212-696-2500.